Hey, welcome to the Mortgage Minute for March the 2nd. Obviously, a lot of the big news in the industry today is two things. First of all, oil, the turmoil that we're seeing in Libya, plus the Bank of Canada rate announcements. What's the connection between the two? Well, let's look at a couple of the headlines. First, as oil soars, businesses brace. The surging, the conflict that you're seeing in Libya, Egypt, the Middle East is going to have a direct impact, obviously, on oil prices. And guess what? That impacts Alberta. Oil sands may save Alberta from red ink. So if you're buying in Alberta, guess what? Probably, and I hate to say it's good news out of bad news, but a higher price for oil is going to help jobs and the economy in Alberta in the short run. Okay, it's also going to put upward pressure on the Canadian dollar. So we look at the big news was Mark Carney this week trying to make a decision. Should he raise rates? Originally, we thought that the Bank of Canada would raise rates by a quarter point. But as we saw, the Bank of Canada decided to stand pat. It's not the fact they did not raise rates. More importantly was the message they sent. And that was really interesting. We all thought, yeah, they might raise it by a quarter point. If they don't do it this time, they'll do it when they meet again in April. But the comments out of the Bank of Canada were very clear. We may not see rate increases for another 3 to 4 months. Now, what's interesting, the domestic numbers that came out would suggest the Bank of Canada should have raised rates. But this headline is really says it. Carney squeezed by domestic needs and foreign forces. So what we're seeing is ongoing issues in Europe. Ireland is in a terrible mess right now. And he said, well, what's that got to do with us? Well, it impacts our export factors. And when you raise rates, you increase the Canadian dollar. So let's take a look at some of the comments that came out of the rate announcement. Economists said the central bank's surprisingly dovish statements suggest Canadians will be able to borrow at historically low interest rates for months to come. So dovish statements, what are they talking about? Carney stated that sovereign worries about debt in Europe, a strong loonie, and poor productivity and high commodity prices are possible areas of concern in the upcoming months. So in other words, yes, we are actually doing quite well in Canada. Our inflation was about 1% higher than expected, and the domestic market still looks strong, but we are not immune to issues in Europe and in the Middle East. As you see ongoing issues in the Middle East, ongoing issues in Europe, it's going to translate into a prolonged period of no rate increases in Canada. Having said that, look for the long-term rates to drop a little bit in the upcoming weeks because the bond markets had already priced in rate increases. Now they're going to soften. So all in all, I think you're going to avoid the rate increase hike for now. So to keep updated on this, check out my website at peterkinch.com, and that is the Mortgage Minute for March the 2nd.